1.9 billion euros. I mean, just let that number sink in for a second. Imagine waking up one morning, you check the accounts, and poof, this massive mountain of cash that was supposedly sitting safe and sound in the bank just doesn't exist. And we're not talking about a rounding error here or somebody misplacing a decimal point. It was entirely unverified. This wasn't some scrappy little garage startup making a rookie mistake. No, this was the sudden, shocking reality for literally one of the most celebrated financial technology companies on the planet.
So it really begs the question, how on earth does a massive European start collapse almost overnight? We are talking about a company that was hyped up as the absolute future of digital payments. I mean, they had global expansion, crazy investor excitement. They were even listed on Germany's ultra-prestigious DAX index. They were supposed to be Europe's homegrown answer to the global payment giants, right? But then, bam. Suddenly, the whole thing evaporates into one of the largest corporate scandals in history.
Welcome to our latest explainer. Today, we're doing a full-blown autopsy on the Wirecard fraud case. We're going to break down the anatomy of this collapse step by step. Because look, this isn't just a story about missing money, though there's plenty of that. It's actually this thrilling, real-world investigation into a total, catastrophic failure of corporate oversight.
See, on paper, Wirecard looked like the perfect company at the absolute perfect time. Everyone was moving away from cash, e-commerce was exploding, and Wirecard, well, they pitched themselves as this fast-growing, DAX-listed global digital champion. And honestly, people bought into it because there was this huge emotional, even national significance attached to it. People wanted a European tech winner so badly that they kind of just stopped asking the hard questions. But the reality lurking just beneath the surface was this incredibly dark web of unverified accounts and these highly complex, completely unchecked third-party partners.
Which brings us to failure one, a complex, untrusted model.
Now, I want to be really clear here. Business complexity isn't inherently a bad thing. Lots of totally legitimate fintech companies operate across borders with super complicated tech. But complexity without transparency, that is a massive hidden risk. So Wirecard was reporting these mind-blowing growth numbers, but their whole model relied on this tangled web of international third-party partner arrangements. And the fundamental questions, they just went completely unanswered. Like, where exactly was the cash? Were these third-party partners actually being independently verified? Were the revenues backed by real, actual transactions? Or were they literally just numbers made up on a server somewhere? You know, when your investors, your board members, and your regulators can't clearly trace where the money is coming from, oversight is basically impossible. And that risk just grows and grows quietly in the dark.
Moving on to failure two, warning signs and blind eyes. You know, the wildest part about all of this is that the collapse wasn't some sudden, unforeseeable lightning strike. No way. The alarms had literally been blaring for years. Long before everything came crashing down, you had journalists from the Financial Times, short sellers, and these incredibly brave whistleblowers practically shouting from the rooftops about Wirecard's shady accounting and overseas operations. But what did Wirecard's leadership do? Instead of looking into it, they dismissed the critics as hostile actors. They aggressively fought back. And then, seemingly overnight, insolvency gets declared when, oh, surprise, that 1.9 billion euros couldn't actually be found.
It really highlights a crucial lesson. Healthy systems do not attack warning signs, they investigate them. Seriously, when an organization faces heavy allegations, a proper board of directors shouldn't just instantly launch into reputation defense mode. They need to stop and ask, wait, what if the critics are right? Who is actually independently checking these facts? Are we protecting the truth here, or are we just desperately trying to protect our image?
Next up, failure 3, the total system oversight failure.
Because here's the thing, it wasn't just the company's internal board that dropped the ball, it was literally everyone. Fintech firms sit right at this crazy intersection of banking, tech, and global commerce, which makes them notoriously tough to regulate. Even Germany's financial regulator, BaFin, later had to throw their hands up and admit they had structural weaknesses when it came to supervising a firm scaling that fast. It became this incredibly dangerous chain reaction of blind trust. Look at the steps. Regulators were relying on the audited statements. The auditors were relying way too heavily on what management just told them. And the investors? Well, they were just relying on overall market confidence and the soaring stock price. It was a total house of cards. The whole system broke down because absolutely everyone assumed that someone else was checking the math.
All right, let's look at failure 4, the audit autopsy.
We really have to zero in on the specific failure of Wirecard's longtime auditor, EY. Germany's audit watchdog later looked into this and found repeated, grave violations in these audits. I mean, they failed to verify one of the most basic, fundamental items on any financial statement, the cash. And to understand how a massive mistake like that even happens, we have to talk about professional skepticism. This is the absolute non-negotiable necessity for independent verification. It means you don't just nod along and accept an executive's explanation just because they sound super confident in a meeting. An audit's entire purpose is to provide assurance, but that assurance completely falls apart when auditors don't apply enough professional skepticism to demand hard, physical evidence for billions of euros that are supposedly sitting in some faraway trustee account.
The ultimate takeaway for anyone in business here is actually brilliantly simple. Trust is not an audit procedure. Verification is. Listen, you can like the CEO, you can be totally in love with the company's vision, but at the end of the day, you have to actually verify the bank accounts.
Which leads us to failure 5, the culture of fear. You see, corporate scandals are almost never just technical math problems. They are deeply, deeply human. Wirecard's corporate identity became dangerously obsessed with protecting its explosive growth narrative, literally at all costs. The success story just ate the company's entire ego. So when the truth started to become dangerous, leadership resorted to these incredibly toxic defenses. We're talking intimidating their own employees, dismissing analysts as enemies, and aggressively attacking the press. They created this toxic, fearful environment where bringing up bad news was practically treated as treason. A strong company culture welcomes challenge, right? It separates ego from evidence. But Wirecard, they did the exact opposite.
And that brings us to failure 6, the collapse of market trust. When you build a massive company on a foundation of toxic culture and unverified numbers, eventually reality is going to catch up with you. When the truth finally got too big to hide and that 1.9 billion euro facade shattered, the collapse wasn't slow. It was instantaneous. See, Wirecard thought they were just a technology business. But here's the reality check. Financial technology is actually a trust business. Merchants need to trust you to process their transactions. Banks absolutely need to trust your financial flows. And everyday customers are trusting you with their sensitive data. Once that credibility is gone, poof. It doesn't matter how beautiful your software code is. The entire business model just instantly collapses into rubble.
So let's wrap this up with our lessons from the rubble.
What's the ultimate moral of this whole corporate true crime saga? Well, first off, complexity absolutely demands stronger oversight. Second, rapid growth is never, ever a substitute for verification. Expanding fast only matters if the numbers are actually real. Also, we have to investigate the warnings, not attack the whistleblowers. Maintain rigorous professional skepticism at every single level. And regulators, they absolutely must scale their oversight to match the blistering speed of fintech innovation. But honestly, above all else, businesses have to build a corporate culture that aggressively protects the truth. Because sure, a great story can pump up your valuations, but only the truth is going to sustain your company in the long run. Which leaves us with one final massive question to chew on today. When you look at the whole picture, was Wirecard mainly a leadership failure, an audit failure, a regulatory failure, or just a spectacular, catastrophic combination of all three? Remember, innovation without accountability isn't progress. It's just a massive risk waiting to blow up. Thank you so much for joining me on this explainer. Keep asking the hard questions, always seek the evidence, and I'll catch you next time as we unpack another fascinating true story.